Taiwan Semiconductor manufacturing company makes about 90% of the world's most advanced computer chips. But TSMC is not slowing down. It is building factories in the US, Japan and Germany. And it just announced that it will be producing 2nm chips starting in the second half of 2025. And that means more speed and more efficient power consumption. And just recently, Apple announced that it will be the first company to receive chips built on the TSMC's future 2nm processes. So this company is and will be crucial to the development of new technologies. So we have one of the most important companies in the world located on an island that is a reason for a lot of tension between two major superpowers, US and China. Without getting into too much detail, US is selling arms, providing military training and other support to Taiwan, and China regards this island as an integral part of its country. And the tension is getting bigger and bigger almost every year. Last year, Warren Buffett said that Taiwan Semiconductor is one of the best managed companies and important companies in the world. But he sold his $4 billion stake in TSMC because he also said, "I don't like its location." So what should we do? Buy? Sell? Sit on the side and just watch the situation develop? Well, let's analyze this company and value it to find out. If you were to invest $1,000 into this company 10 years ago, you could buy around 59 shares. And now they would be worth something close to $6,874. And this company also pays dividends, so in that time you would get $820 as dividends. So if we add together the current value of shares and the dividends, we get $7,694. And that is a gain of 669% in 10 years. Very impressive result. But as we know, the world can change surprisingly fast, and the future does not have to look anything like the past. So let's take a look at the company itself. Individual insiders, that is an X, only 0.4% of the company is owned by individual insiders, and we would like to see this number over 2%. And are individual insiders buying? That is an X. In the last year, we see no transactions from individual insiders whatsoever. And do super investors own this company? That is a check. There are 14 super investors, including people like Stephen Mandel, David Rolfe, and David Tepper. And are super investors buying right now? That is a check. In the last quarter, they bought over 1.8 million shares and sold over 1.6 million shares. So the difference is not huge. Return on invested capital. That is a check at 21.8% 10-year median returns. And we want to see this number higher than 10%. So that confirms Warren Buffett's opinion about the management of TSMC. And what do we know about net profit margin? It is a check at 38.2%, and the industry average is just 16.5%. So it has a very significant advantage over its competitors. And it's not really surprising because they are leading the industry with 3nm and in the near future 2nm technology. And now let's take a look at share buyback. It is an X. We see no change in the number of shares in the last 10 years. So they are not buying back shares, but at least they are also not diluting investors by issuing new shares. And what about the debt? It is a check even though they have a significant debt, but they also have so much cash that they could pay it at any moment and still have around $15 billion left. Revenue growth, that is a check at 15.5% 10-year compound annual growth rate. And we would like to see this number higher than 10%, so that is a nice result. And free cash flow growth, that is a check at 29.1% in the last 10 years. So that is impressive. This company is growing at a really high speed. And let's take a look at the earnings per share growth. That is also a check at 19.4% in the last 10 years. And also here, we would like to see it higher than 10%. So we have a company that is a leader of its industry and is still growing beautifully. The dividend yield is 1.6%. So in the last year, shareholders got $1.84 per share through dividends. And the payout ratio, that is a check at 35%. And we want to see the payout ratio somewhere between 20 and 50%. So we are getting a nice part of the company's earnings, but it is not so big to actually disrupt the growth of the company. And what about dividend growth? It is a check at 7% 5-year growth rate. So as we can see, the growth is not very stable, especially when we take into consideration the currency exchange rate, but it is growing in the long term. Price to earnings ratio is 22.6. So in comparison to the average S&P 500 PE, which is around 25, it seems that it is actually not that expensive. But let's value this company using a discounted cash flow formula. And for this valuation, we will use a 5-year average free cash flow because in the last few years, we actually see a lot of volatility. So taking the average free cash flow should give us a more realistic starting point. So in the low scenario, we will estimate a growth of 13% for the first 5 years and then 12%. In the medium, 18% and then 15%, and in the high scenario, 25% and then 20% growth. So the low scenario is close to average predicted growth of the semiconductor market, which is 12.3% till 2032. Medium is close to the past results of this company, and the high one is predicting that TSMC will actually do a bit better than it did in the past. But not crazy better, just a bit better. So, with such estimates, the intrinsic value in the low scenario is $58, in the medium $77, and in the high scenario $117. But we have to always apply a margin of safety to those prices. I use a 30% one, but you can use any margin that makes you feel comfortable. And with such a margin, we get in the low scenario $40, in the medium $54, and in the high one $82. And the current price is around $116. So only the high scenario without the margin of safety is in the green. So we have here a company that is really a backbone of the technology industry, and it is growing really nicely. Also, it has great financial health, and on top of that, it is paying a dividend. The price is probably a bit on the high end, but considering how strong this company is, it is actually surprisingly affordable. But then we have to understand that the price is not skyrocketing because of the location of this company. Investors know that as the conflict between China and the US gets more intense, this investment is becoming riskier. If those superpowers find a peaceful and stable long-term solution, then it can be a great investment opportunity. If not, then we all could have a lot more problems than just losing money in this stock. If you found this video interesting, you may want to see my analysis of a Chinese company called Pinduoduo. Thank you so much for watching and see you in the next one.